Hey guys, welcome back. In this video, we are going to solve one problem from insurance loss of stock insurance claim chapter, which is from financial accounting, and this is one of the crucial problems. This one can create the this one can give the entire understanding of loss of stock problem. Any problem arise from this chapter, we can handle any kind of problems with this one problem. Okay, this is the Brookback problem given in the given for insurance claim, and let's quickly solve this problem. Okay, Exxon company suffered a loss of stock, okay, due to fire on 31/3/2023. So this is the fire date. Prepare a statement showing the claim for the loss to be submitted. So we need to show the claim amount. Okay, purchase for 2022 and purchase for 2022 and sales for 2022 is given here, and purchase from 1/1/2023 to 31/3/2023 has been given. This is the fire date. Before fire date, what's the purchase and what's the sales made, which has been given here, and the sales on 2022, sorry, stock on 2022 and stock on 2023 has been given. This is the opening stock, this is the closing stock. So they haven't given the GB percentage directly, so we need to find out. We need to find it out by preparing the trading account for the previous period. So this is why these informations were given. Okay, an item of goods purchased in 2021 at the cost of rupees 20,000 was valued at 20,000 on 31/12/2021. This is the actual tricky part in this problem. We need to have a clear focus to have a grip over this area. Okay, I'll go with the timeline so you will get the clear understanding of what it means. Okay, right. Okay, on 2021, goods purchased rupees 20,000 was valued at, which is WDV, 12,000. Okay, sorry, this is valued on 31/3/2021, just 12,000 WDV of this amount. Okay, and then this is just the split of we can. Okay, before that we'll quickly read the question. Of these goods were sold during 2022 for 5,200. Okay, off of 20,000, which is 10,000, right? 10,000 has been sold during 2022 period. Okay, 2022 period. Okay, 1 minute. This is 31/12 because the financial year ends at December, right? So 31/12/2021. Okay, WDV. And during 2022, half of the goods were sold for 5,200. Let's quickly write it. 50% sold. Half sold at rupees 5,200, and then remaining stock, which is on 31/12/2022, which is valued at, which is WDV is rupees 4,800, which is WDV. Okay, and then on okay, 1/4 of the original stock, which is 50% in this 50%. Okay, 1/4 of the original stock was sold for rupees 2,800 in February 2023, and remaining stock was valued at, okay, Of sold in off valued stock, off valued closing stock. This is the off valued closing stock. Okay, in this off valued closing stock, off has been sold, which is amounted to rupees 2800. 25% sold, 50%. Okay, this is the 100% amount. 100% has been split into 50% and 50%, 50%, and then this 50% has been split into 25% and remaining stock, which is half of off valued closing stock. Okay, this is also 25%. Okay, first they splitted the 100% into 50-50, then later 50% into 25-25, and 50% has been sold, which is cost for 10,000. 10,000 is the original cost, right? And 10,000 has been sold, and remaining 10,000 is kept for 4,800. This is the WDV, and half of it were sold for 2,800, but the cost is 5,000, because this is the half of this percentage, right? So 5,000, and 5,000 kept under remaining stock. Cost is 5,000, but what's the WDV, which is 60%, right? Then 3,000. 60% of 50%, 5,000 is 60 is 3,000. So in usually when we are computing the opening stock or closing stock under insurance method, we need to find out the original cost value. We should not use the WDV, and we should if the value is the written down value, we need to make it normal value. We need to make it as a normal value. That's why this process we have been undertaken here. Okay, so first we had a original cost of purchases worth 20,000, but the WDV is 12,000, so we have reduced the price. Then the WDV value has sold for 5,200. So 5,200 is costed 10,000. Then off has been valued in books as 4,800 on 31/12/2022. Then the off were sold. So the off of 50% were sold, and off of 50% has been kept as closing stock. Okay, see, okay, I'll mark it as cost sale. Okay, WDV cost, sale cost, WDV. Okay, so we found out we have tracked every cost of the sold item and WDV of remaining stock, so we can directly jump into the problem with this understanding. So what else information has been given here? Stock salvage and insurance policy value as 3 lakh. Okay, let's quickly have a understanding of how many approaches, how many steps involved in this problem. 4-step approach we are going to follow for most of the insurance claim problems if they haven't given the GP percentage. So the first one is trading account. Okay, with this trading account we are going to find out the GP percentage. The second step is memorandum trading account. With this we are going to find out the closing stock on date of fire. third one is loss of stock. This is the calculation of closing stock on date of fire minus stock salvaged. Last step is amount of claim. If it is under insurance, we are going to use the formula which is loss of stock into policy amount divisible by closing stock on date of fire. Okay, so this is the overview of this entire problem. So let's quickly jump into this problem. Okay guys, answer. Trading account. Okay, to opening stock by closing stock. Okay, fire date is 31/3/2023. Previous year is 1/1/21 to 31/12/2021. Okay, sorry, 2022. So we are preparing the trading account for the period 1/1/2022 to 31/12/2022. Okay, set. Okay, we have a data since 2021. So on 2021 we purchased the goods worth 20,000. On 31/12 the goods WDV is 12,000. So in the opening stock we had only the WDV of 12,000. We need to add the 8,000 which has been removed here. So 76,800 plus 8,000 which is the removed value since due to the return down of 8,000. Okay, we have added back. So what's the closing stock total, sorry, opening stock value? 1 minute, let me take calculate. 76,800 plus 8,000 which is 84,800. Okay, what's the sales amount for the year 2022? 4,05,200. 4,05,200. Okay, what's the purchase value, which is 3,20,000? Two purchases which is 3,20,000. Then we need to find out the GP and closing stock value. For closing stock we have information that which is 63,600. But there is a adjustment given here, which is that on 31/12/2022, right, on 31/12/2022 we have a return down value of 4,800. So the cost is actually 10,000, but we have only included the 4,800. So we have left the 5,200 which needs to be added here. Removed amount of 5,200, right? So 63,600 plus 5,200 which is 68,800, right? So now the balancing figure is 84,800 plus 3,200, sorry, 3,20,000 plus 68,800, which is 69,200 is the balancing figure. I hope you guys have understood the logic here. Here we use the WDV value, so we have ignored the 8,000 amount right here. So we have added back here. So to while we are preparing the trading account for insurance, we need to show the normal values only. So we have added back the 8,000. On 31/12/2022, we have showed the off valued closing stock, which is 4,800, but the original cost is 10,000. We have ignored 5,200 here. So this 5,200 has been added back. Here 8,000 has been added back. Okay, right, we have prepared the trading account. Let's quickly find out the GP percentage. Gross profit divisible by sales into 100. Okay, okay, we have the GP value, and as well we have the GP value as well as the sales value, but we need to find out the normal GP percentage. Here we have included the abnormal sales item also. The abnormal sales item is, see, 10,000 worth goods has been sold for 5,200. So we have to segregate the normal sales and abnormal sales here before proceeding with the GP percentage. How can we do that? The sales value is how much? Which is 4,05,200, right? When we are splitting it to normal sales, abnormal sales, abnormal sales value is 5,200. See, it has been given here. Then normal sales would be 4,05,200 minus 5,200, which is 4 lakhs is the normal sales, right? We don't know the profit for this amount, but we know the sale value for this amount, which is 5,200, and also we know the cost, which is 10,000. What's the loss here? Loss is 4,800, we know. And then, so if we have a loss of 4,800, we have a net profit which is 69,200, right? So what could be the profit for us? 74,000, right? Have you guys understood this logic? We have a loss already in our books, which is 4,800, and we also find out the 69,200 net profit, which is the overall profit. So if we add back this amount with this value, we get the actual profit for this, the 4 lakh value. So we found out that 74,000 is the profit for 4 lakhs. So 74,000 divisible by sales is 4 lakh, normal sales, okay, 200, normal profit, normal sales. 74,000 divisible by 4 lakh into 100, which is 18.5. 18.5 percentage is the GP percentage. So let's quickly get into the second step, which is memorandum trading account. To opening stock, which is the closing stock of last year, which is 68,800. To purchases, how much was the purchases? 1,08,000. How much was the sales before fire, which is 1,22,800 by closing stock. which is so that we have to find out. This is the closing stock on date of fire. Okay, to gross profit. We don't know both the values, but here we have the GP percentage, right? 18.5 percentage. So with that we are going to proceed that sales during the period is 1,22,800, as same as the previous year. This year also there is a abnormal sales happened. See, sales of 2,800 happened with the stock of 5,000. Okay, so abnormal sales is 2,800. Costed 5,000. Okay, normal sales, which is 1,22,800 minus 2,800, which is 1,20,000 into 18.5 percentage gives us the 22,200 as gross profit for normal sales. Okay, here we face the loss of 2,200 net of, we get a profit of rupees 20,000, right? So we are going to insert that 20,000 here, and we need to calculate the closing stock on date of fire, which is the balancing figure. So 60,800 plus 1,08,000 plus 20,000 minus 1,22,800, which is 74,000 as the closing stock on the date of fire. Okay, so we found out the closing stock on the date of fire. Further problem is just a cakewalk. Okay, third step is what? Third step is loss of stock. Which is closing stock on date of fire minus stock salvaged. Closing stock on the date of fire is 74,000, right? 74,000, right? Yes, minus stock salvaged is, salvage stock is 24,000. So 50,000 is the loss of stock. So what's the amount of claim? Closing stock on the date of fire is 74,000. Policy amount, which is 3 lakhs. Before that we have to correct one thing, guys, which is closing stock on the date of fire. We need to provide one working note which includes that correcting this amount, which is WDV of 60 percentage. We need to add back the reduction, which is 2,000, right? So we need to add back that amount also to the closing, to bring back the closing stock on the date of fire to normal stock level. So 74,000 is the closing stock on the date of fire, right? Plus 2,000, which is the reduction in stock, minus stock salvaged, which is 24,000. So it comes to guys, this is the reduction in stock, no? So we have to reduce this amount to the closing stock on date of fire. So we'll get the value that, which is 48,000. Okay, so we got the 48,000 value, and this is not the under insurance. So policy amount, which is 3 lakh, loss of stock, which is 48,000. Whichever is lower is the claim amount. That's it. I hope you guys have understood this problem. The fire occurred on 31/3/23 and the previous year is 1/1/22, 31/12/22, and the company has a practice of reducing the values to WDV, so we need to add back whatever the value has been reduced from the stock. 8,000 and the cost of 10,000 goods were sold for 5,200, which is the abnormal sales, and cost of 10,000 has been valued as 4,800 in the books, which we need to add back 5,200, and off sold in the off valued closing stock, which is 2,800, which is the abnormal sales, and at the last 5,000 and the WDV is 5,000. We need to deduct that 2,000 due to the reduction in the cost of reduction in the cost in the last time or last period. Okay, 4-step approach. Trading account and GP percentage we need to find out with that. Memorandum trading account, we need to find out the closing stock on the date of fire. Closing loss of stock, we are going to find out with the closing stock and stock salvage difference. An amount of claim with the loss of stock into policy amount divisible by closing stock on date of fire, if there is under insurance. And we find out that every problem, added back the WDV difference, and we put the sales divided into normal sales and abnormal sales, and we found out the GP percentage like that. See, and we found out the closing stock on date of fire, and we calculate the policy amount. That's it. Thanks.